And welcome back to the afternoon of our Financial Markets Quality Conference. Glad you're all here. And my name is Jim Angel. I'm a finance professor here. And at this session, we're going to talk about the empirical evidence market quality. So we have a very distinguished panel here. I could easily spend an hour and a half going through their illustrious credentials, but you can read those in the program. We have Pete Kyle, Ingrid Werner, Amy Edwards, and Richard Gorelick. So I won't steal their thunder, but there's plenty of thunder coming. But first, I'm going to exercise the right of the chair to just give a little bit of an introduction. And if you look at it, by all their traditional metrics, market quality right now for the U.S. equity market is actually pretty good. Now, I know that these slides are way too small to see, but if you things like execution speed, it's vanished. As was discussed earlier today, we now have instant executions. Transaction costs have fallen substantially. Intraday volatility, lower than it was back in the bad old days. So by traditional metrics, our market's looking pretty good. But does that mean it can't get better? Of course not. But are we even looking at all of the right metrics? Just because we measure something, are we measuring the right things? Because our markets do a whole lot more than just match the buy and the sell orders. They produce information. They produce the price. They produce fundamental information about the companies that we're trading. Are we producing enough information? And indeed, we have this tendency to transaction costs bad, with the unspoken idea that the optimal transaction cost is zero. Is it really? To say that the optimal transaction cost should be zero is like saying the optimal price of bread should be zero. Might be nice if you're a consumer, but who's going to bake it? So, what is the optimal transaction cost? Especially when you take into consideration the fact that markets produce a lot more, than just matching orders. They produce information, and so we have these externalities to consider. Are they producing enough information? If you look at other metrics, are our markets doing their job of providing capital to new companies? We have less than half as many U.S. public domestic listings on our exchanges as we had 15 years ago. Is this good or bad? What's causing this? How accurate are the markets? We talk about price being the present value of the future cash flows, but when you actually look at the numbers, our markets are not doing a great job of actually predicting what those future cash flows look like. Turns out, if you take a look at stock prices, compare them with the discounted present value of the cash flows to shareholders, guess what? Only about half the time does the market get within a factor of 2 of that discounted present value. And here's a graph, and the key thing to look at is the dark blue line there. Let's see, does the laser work on this? No. Okay, and what that's basically showing is the fraction of stocks. The blue line is within a factor of 2. And what it shows is that, from the 20s basically up to the early part of the zeros, looking at a 10-year horizon, only about half the time does the market even get a factor of 2, the discounted present value. So what we have is we have very noisy markets. But there's more. And so what I will do is I will turn it over to Amy Edwards from the SEC, who will give us an update.
Thank you, Jim. I actually won't be talking about the existing evidence. I'm going to lay a bit of a foundation, and we'll have Ingrid and Pete and Richard to talk a little bit more about evidence. But I guess before I talk, I will give my standard disclaimer. which is that my opinions are my own. I will be talking for myself and not on behalf of anybody else at the commission, any of the staff members or commissioners. But I think what I'll start out by saying is I think we've all heard a bit about the chair's speech on June 5th and her follow-up speech a few weeks later. And one thing that I wanted to point out in there is that the chair did say that one market structure does not fit all. And I think that you need to keep that in mind when thinking about equity market structure and market structures even outside of equities. She also mentioned that the SEC was going to take a very careful study of the markets and have very deliberate action. She also mentioned being very data-driven. And so what I'll highlight here is a few of the data-driven elements that are coming out of her speech or may have been ongoing prior to her speech. One element that I'll talk about really quickly is limit up, limit down. We mentioned it briefly this morning. In case you weren't familiar with it, limit up, limit down actually is in a pilot right now. It has not been approved permanently, and the SROs are actually in the process right now of studying that pilot and considering whether or not to change limit up, limit down before making it permanent. And this study, the data analysis that they're doing right now, will go directly into that decision. Second is in fixed income. We mentioned fixed income briefly today. Others will probably talk about it more this afternoon. But there is this idea of pre-trade transparency. And again, in that element, we have to think about data-driven and being very careful, doing a careful study and taking deliberate action. And I think that's one of the things we intend to do. In fact, I would say that one thing that's very different about my division, the Division of Economic and Risk Analysis right now, and my office, the Office of Markets, is I actually have people who are lining up to study the fixed income markets right now. And that's very refreshing. It hasn't always been that way in the past. And so I have a lot of people who are dying to study the fixed income markets, and they're going to get a chance. Subject to, of course, covering all the equity market analysis that we have to do as well. The third thing that I'll talk about a bit in more length is the tick size pilot. So as you know, on June 24th, the Commission issued an order to order the exchanges and FINRA to put together a plan for conducting a tick size pilot. And the order was very prescriptive about what that plan needed to do. The SROs did file their plan on time on August 25th. Hopefully that will go out for public comment sometime soon, and it will be out for public comment. So there will be a sufficient public comment period for people who are interested, whether they're academics or in the industry, or anybody else with an interest in studying the tick size pilot or an interest in tick sizes in general, to comment on the tick size pilot. So it'll be very interesting to see what the public comment says, and be very happy to hear any opinions from anybody, even Jim. But in general, as said in the order and elsewhere, the general objective of this tick size pilot is to produce data for studies to facilitate analysis of the effect of tick size on liquidity, execution quality, volatility, market maker profits, competition, transparency, and institutional ownership. We're not making this pilot objective to be about IPOs. It is focused on small companies. It's focused on common stocks in companies with less than $5 billion market cap, with average daily volume less than 1 million shares, and with prices greater than $2. It would be, according to the order, it is a one-year pilot, and it would create or would test the difference between a 1 penny tick and a 5-cent tick. It would be structured to have 3 test groups and 1 control group. The first test group would have a quoting increment of 5 cents, but the trading increment would be the same as it is today, which is to say there isn't one. The second test group would have both a quote and a trade increment. The third test group would have a quote increment, a trade increment, and a trade at rule. And one of the reasons that Steve alluded to this morning for why we have these three different buckets instead of just one, just looking at quote increment and of 5 cents and 1 cent, is because we really don't know what the optimal way to change tick size is today. And so this gives several options to study to see if we were to increase tick size, how would we want to do it? What other regulations would have to change tick size? Another element that was in the order that would be interesting to hear comment on as well would be on the data. So there's generally three types of data. The first type is just data that identifies the pilot securities. And this really comes from the regulation SHO pilot, where at that point in time, the exchanges decided to put out data that just identified all the pilot securities every day. So this is the same sort of data. It's going to identify all the pilot securities every day. And it will also identify the set of securities that were eligible to be in the pilot but were not selected. So it's also going to identify the control stocks then as well. So that's a slight change from regulation SHO. So every day, if there's a ticker change, somebody changed their name, this data set would identify which exact securities, what the ticker symbols are for the securities that are in the pilot. The second set of data is really more like studies. The exchanges under the order are required to conduct analyses themselves of the pilot. And these analyses include analyses on market quality, on the number of registered market makers, on market maker participation, market maker profitability, and on transparency in their markets. These are all issues that were debated and discussed prior to the order and things that people really wanted to know about with the increase in tick size. The effect on market makers in particular is one element that gets us a little bit closer to this idea that you may have more analyst coverage. And so, Richard is laughing. But I think if you're going to have more analyst coverage, if you're ever going to be able to reach that hurdle, then you've got to have the market maker profitability results. And the exchanges are also going to be required to see if there's any obvious thresholds for changes in tick size by looking at this sample. They're also going to be comparing the different tick size groups to see which group seems to make the most sense. But just because the exchanges are studying it doesn't mean that that academics aren't going to be studying it. In fact, the third set of data will be data being made public by the exchanges to facilitate the analysis. And this data is really meant to supplement the publicly available data, such as the TAC data that most people use, and some of the data available on the market structure website. The first set of data that the exchanges would put out is really 605-like data. So this, instead of having the monthly 605 data, this would be daily data. So you'd get the 605 statistics, but they would be estimated daily, and they would include orders that are not currently included in 605 data. The others, I guess in addition, we may have more market maker information. So the exchanges will put out the number of market makers registered in each stock during the pilot, in addition to the market maker participation and the market maker profitability in those stocks. These would be aggregated. You wouldn't be able to pick out any particular market maker, but it would provide some information to the public to be able to study the pilot. Finally, there would be a data set of just raw orders, market and marketable orders that would be made public, scrubbed so you couldn't tell who they were from, but there would be market and marketable orders that would be also made public during the pilot. So that was generally what was in the order, what the structure of the pilot will be, and it's really focused on the ability to study and to generate data for analysis, so we can make a very careful study and be very deliberate about tick sizes. The next step in the process will be for the Commission to notice the filing by the SROs, and it will be out for public comment. I don't know how long that public comment will be, but often it's extended if it's not long enough. Afterwards, the Commission will consider a lot of the comment, consider whether or not to approve, consider whether to amend, and the tick size would go forward if the Commission approved. And I think with that, I can hand it back to Jim.
Okay, thank you. Our next presenter is Ingrid Werner from Ohio State.
Thank you. Now if I can stop handling the microphone, you will be better off. It's a great pleasure to be here. Thank you, Rena and Jim, for inviting me. And I'm going to talk about tick size and market quality, and it will hopefully relate, I guess we should have it in view mode, to Amy's, there we go, Amy's comments. And I'm going to just give you a little bit of an overview first, why this study is important, and I probably am preaching to the choir. But obviously, you remember that tick size have gradually declined over the late 90s, early 2000s. And the experience that we had with that decline in tick sizes was a reduction in spread, but unfortunately also a reduction in depth. Now, that obviously had bad consequences for institutions potentially, and some argue that institutional trading costs went up, although retail trading costs went down. There was another aspect of this change that until recently, until the 2012 Jobs Act, hadn't been pointed out. And that is that the reduction in tick sizes actually, that started with sixteenths, moved from 1/8 to 16ths in 1996, and went on through Reg ATS, the decimalization in 2001, coincided with a reduction, as this graph shows. The blue field in this graph is the proportion of firms that are doing an IPO that are below $50 million. And this is part of the evidence that was supported the Jobs Act in suggesting that we need an increase in tick size for smaller firms. In 2005, in addition, there was Reg NMS, which we have spoken about repeatedly already today, that actually regulated the minimum price increment. And today, the minimum price variation when an order is posted in the market is 1 cent for stocks that are priced above $1, and it's actually a sub-penny, 0.001, if stocks are priced at $1 and below. Now, however, there was an exemption made by the SEC, and effectively, a broker can apply to be exempt from the rules so that you can actually trade in sub-pennies, in sub-increments, even for stocks priced above $1. And it implicitly allows, therefore, sub-penny trading. And exchanges have recently actually announced plans in 2014 for these kinds of, it's called the price improvement plans, and market participants claim that dark venues, not just exchanges, are using this exemption extensively, effectively to create, through an algorithm, price between the best bid and offer inside the NBBO in dark markets. And we had a discussion about this ahead of time with Amy, and literally I pulled a quote from the ITG Inc.'s website where they say, although order instructions from clients will not be accepted if they're priced at sub-penny, at sub-penny limit, ITG's posted match and posted now ATS will continue to execute matched orders at prices between the bid offer, which may result in sub-penny execution. So clearly it's happening. Now, at the same time, we had a growth because of this exemption in sub-penny trading. So we had tick sizes declining, and then we had an increase in sub-penny trading. The graph on the left shows the fraction of trades that are in sub-penny price increments, and it's from 2006 to 2012. I know it's small, so it's hard to read. The graphs on the right show the distribution of those sub-penny trades for a sample that I used in a paper with a couple of co-authors. I'll mention it in a second. And you see there's a big spike in the middle. That's the midpoint, the frequency of trades at 0.5, 0.5%. But clearly there's a distribution around that. And in the bottom graph, which is very hard to see, there's actually a systematic pattern between those trades who are priced not at the mid, but actually in sub-pennies, just basically dumping ahead of the existing quotes, and price. If price is low, there's a higher proportion of trades that are executed in sub-penny. The same pattern is not visible for midpoint trades. Those are the red group of trades. Now, why does it matter? Well, if you look at the spheres here, and these are not exact proportions of trading volume, but we have the market on the left with the lit trading about 2/3, dark trading about 1/3 of trading volume. And for the most part, the lit markets, the limit order books that you can see visibly, are actually quoting and trading in penny, and the dark markets are trading possibly in sub-penny. Obviously, they can also do price improvement in penny increments as well. And the distribution on the right shows that this is the breaking out the sub-penny volume. It's both broker-dealer internalized trades and those in dark pool matching venues that we usually call dark pools. Now, this recently, I just added this, the exchanges have now price improvement programs which allow them to execute at midpoint for retail orders. So you can see sub-penny executions both in lit and dark markets, but the preponderance of them in our samples that we are looking at are actually from dark venues. So what does it matter? You know, why do you care? Well, right now we just talked about, I mentioned the Jobs Act, and actually the whole tick size pilot is sort of addressing this issue that there may be not an optimal tick size that's the same for all firms. Maybe we need to examine whether the tick size should change for certain groups of firms, and the Jobs Act points at emerging growth companies, small companies. They don't exactly define what they mean by that, but Amy and her colleagues have tried to come up with a reasonable definition for the focus firms for this exercise. At the same time, so that would mean increasing the tick size. At the same time, the exchanges back in 2010 requested the SEC to conduct a study of sub-pennies, of actually reducing the tick size for firms below $20. And why did they do that? Because they thought that the tick size was constraining for lower priced stocks. So we have basically decisions or suggestions to go increase in tick size or decrease in tick size. So when you try to go about this from an academic perspective, you try to understand the forces at play here. And I have worked with a number of co-authors trying to do so both in theoretical work and empirical work, both studying tick size, sub-penny, and actually dark pools, which I will talk less about right now. And I want to mention their names: Sabrina Butti, Francesco Consoni, Barbara Rindi, and Ranji Wen. And I'm not going to talk about the theoretical papers, but they all have empirical components as well. Now, why is it, can't we just like invert the results from before? When we decrease the tick size, we saw spreads go down and depth go down. Doesn't just automatically go the other way if we increase the tick size? It's not exactly that simple because markets have changed. They've changed rather dramatically. And we used to have a market with a market maker and intermediating trades from customers where a customer could choose not to trade or submit a market order. Now we have a transparent limit order book in the majority of trading still, where buyer, for example, comes into the market, decides whether not to trade, submit a limit order or submit a market order. He's alone there, so he's not going to submit a market order. So another buyer maybe comes in, still no trading possible, right? Because there's no one there. But the seller comes in, and if the prices are agreeable, he can submit his market order against the existing limit order, and a trade occurs. So when you try to model this, you have to try to understand how these trading strategies change with changes in, say, the tick size. Now, the market is much more complicated today. Even just in this very simple example, the trader now has two more choices. He can submit an order, also a limit order or a market order to a dark venue. And again, we have to have someone else to trade with. This is an Australian guy because he's upside down. Otherwise, no trades will take place. So when you try to kind of understand how the markets actually would react to a change in structure, you have to actually go and think through everyone's change in strategies. And the key trade-offs that we're talking about is basically, do you want to have immediacy, you pay a higher price for liquidity, or are you more patient and submit a limit order and hope for the best that a trade will occur at the other side? Now, if you have additional venues, such as dark venues, you could possibly, you have even uncertainty on your market order that you submit because you can't see the liquidity. And in addition, if you submit a limit order, you have to wait. So this just exacerbates the problem. So these are the key trade-offs. I don't have time to go into any of the details because you want to hear about empirical evidence. Just going to visually see what we're talking about. What happens when you change the tick size? In this example, you have a large tick size in the leftmost pane of tau, which is from A1 and A2 are two sell prices, and B1 and B2 are two bid prices, and you have a spread there, and they're at the inside. Now, if you reduce the tick size to the finer grid from lowercase a, you can jump ahead of the existing order. So the idea of what happens when you have the ability to jump ahead? Now, you can think that market quality should go up because the spread is narrowing, but that doesn't have to be the case because, in fact, it may be that the liquidity providers know that you're going to jump ahead, so they won't post the narrow spread in the first place. So it becomes an empirical question. What happens? Now, to complicate matters, we have the sub-penny trading in dark venues, and also here you can undercut. So the idea is that you can trade in a second venue at a finer price grid. Similar argument for what's going to happen to the market quality. It's an empirical question. We have predictions from theory. So what does the evidence suggest? Well, in our study, what we did, we looked at, this is very small for you, I'm sorry. I thought it would be like big as in the back. But we studied two samples. One is London Stock Exchange stocks, and the other one is from the US on the right-hand side. The difference is in the European markets, they actually have a mapping between price levels and tick sizes, so that when the price of a stock goes up and reaches a certain threshold, there's a discrete change in the tick size. It allows you to actually, for the same stock, see what happens when the tick size increases. In the US, this is not possible currently, unless you're looking around $1, because all stocks are traded at the same tick. So in that sense, you have to look at the cross-section instead. So on the left, when we actually study the sample from the London Stock Exchange, what we find is when there is an increase in the absolute tick size, depth increases, and both the absolute and the relative spread increases. So that is actually exactly the flip side of the historical evidence. When we look at the NYSE and NASDAQ, it's a little bit more complicated. We try to control in the cross-section for what to expect and just try to isolate the effect now of moving the price instead of the tick size. We have to move the price, so relative to the price, the relative tick size changes. And in this study, we find that indeed, when you have a larger relative tick size, that is a lower price stock, controlling for other factors that would actually affect market quality measures, we find a higher depth and actually, in this case, a lower spread. Now, we are not the only ones who have studied this question. We have two studies, one which was already mentioned by Maureen O'Hara, Gideon Czar, and their co-author Zhong, and they look at the cross-section of stocks as well. They look at NYSE stocks only, and they have a richer data set, and their lessons are that we actually have the results of a lower price relative to the tick size. That means a wide tick to price ratio. They see that, yes, indeed, there's higher depth, But because they can drill down a little finer into what's going on behind the scenes, they see that a larger fraction of the orders are actually hidden, and they don't replenish as quickly as they do when the tick size is smaller. And they find no difference in spread and no significant changes in volume. There's another paper that looks at the crossing of the threshold of stocks around $1 in the US, and very similar results. And what we find, generally speaking, is that a wider absolute tick size seems to be associated with, in today's market environment, with more depth, but wider quoted spreads, at least according to the English and the English and the US data, around $1. And theory would predict that volume and welfare would also fall. I'm going to speed ahead. We also took a look at sub-penny in the empirical work, but rather than take time on the details now, because I think we're running low on time, what I'm going to do is just summarize that. So what we find when we look at sub-penny trading is that what seems to be happening is that the more Q jumping that we see in the data, the better is market quality. In fact, it's associated in the data with actually more depth, narrow quoted spreads. However, other authors have found, I warn you, that there's also wider effective spreads and lower price efficiency. So the jury is clearly out here on the ultimate results of changes in tick size, which is why we need the study that the SEC is going to do, the pilot, and it will help us actually disentangle all the evidence that we have from different markets, because remember I said the deficiency from the researcher's point of view, looking at the US market, is that you cannot have discrete changes in tick size. That's exactly what the study is, the pilot is designed to do. So I'll stop there and I'll leave the word to, is it Richard now?
Richard.
Yeah.
Okay.
Yes, and now we have Richard Gorelick from RGM.
Thank you, everyone. Probably need
Another mic.
Yeah, I didn't get my own personal lapel microphone. As a practitioner, apparently I speak loudly, so maybe I thought I didn't need one. So first of all, I wanted to thank Georgetown University and Rena for hosting this conference. I think it's been very informative, and wanted to thank Jim for hosting the panel today. I am a practitioner. I'm not an academic, but I do like to think about things from a very data-driven angle. So I thought this is a very good panel for me to participate in, sort of bring the practical market participant view into the discussion. Here, I'll speak fairly quickly on some of these slides because a lot of it's been covered today already. So generally speaking, I think as we've heard, panel after panel, traditional metrics of market quality have all improved over recent decades in the US equity market. So the market quality from the way we traditionally look at things has gotten a lot better. There have been a lot of very highly publicized claims that high frequency trading has hurt certain market participants or eroded market quality. But generally speaking, the evidence suggests that things have gotten better over the same period and that automation and competition have resulted in improved market quality. The market structure debate in recent months, and as I think we've seen a lot of that today, has shifted from this general sky is falling question about whether or not markets have gotten better or worse, but rather to a discussion of how specific market structure reforms might improve markets further from what we have today. And I think the goals of this reform, and we've heard about comprehensive or holistic market structure reviews at the SEC, are to make markets even lower cost, more resilient, more fair, more transparent, and less complex. And these are sort of goals that a lot of people have agreed in and have been talked about widely, both from regulators, policymakers, market participants, exchanges across the board. My view, and I think it's a view that's been echoed today repeatedly, is that discussions of market structure reform should be based on a very thoughtful analysis of empirical evidence about what's going on in the markets. And I'm really pleased to say that I've seen that more and more coming out of the regulators, that there's more and more discussion of data. The SEC in particular with their Midas data set and their website where they're actually looking at what's going on in the markets and myth busting to an extent has been really helpful in illuminating the discussion. So I'm going to talk a little bit more about the tick sizes, which we've talked about all day long, sort of as a window into not just the narrow issue of tick sizes, but also how do we think about market data? How do we think about empirical evidence in the policy-making process? And what is the right role for that? And this is a great example, a great opportunity to dig in on that. So I've got my great Investopedia definition of tick sizes, which probably makes some of the academics snicker a little bit. But basically, if we talked about it, it's the minimum price variation that's allowed in a stock. And there's been a lot of interest in this, or in an instrument being traded. There's been a lot of interest in this around the world over the last couple of years. It's not just a U.S. phenomenon. So we've talked about the U.S. pilot program. Also in Europe, though, MiFID II regulation requires that regulators are going to set tick sizes across the board, across all of the European markets to make sure that they fit the appropriate profile of the instruments being traded. Japan recently, the Tokyo Stock Exchange, changed the tick increment, reduced it significantly in a number of instruments, and they're sort of rolling through waves of that change. And I do urge that from an academic standpoint, there's probably a lot of rich areas to study with that Japan tick change as well. There's also been academic interest. Both of these papers that I was featuring have been covered extensively today, but they're good papers that have come out recently that looked at this issue from a number of different angles and generally concluded that the evidence suggests that maybe smaller tick increments might be helpful, but that there's not a lot of evidence that in most stocks, larger tick increments would be helpful. So one of the things that occurred to me when reading the papers and engaging in these discussions is there is this mythical attempt to find the optimal market structure for all participants. And there's this idea that there is a market quality that should be measured consistently for everyone at all times. And I think that's great. And there's certainly ranges over which we can probably all agree that market quality has been improved. But essentially at the core, there is a balancing act. And that applies for lots of different policy decisions, but no less so for the question of tick sizes. And there are trade-offs. If your tick sizes are too small, meaning that there's too much granularity, it really reduces the incentives for traders or market makers to leave orders resting in order books because it's very easy for, as Ingrid suggested, for someone to just get in front of you by a very minuscule amount of price improvement. It also, with that finer granularity, comes to a lot of higher message rates. So if there is a tick increment that's very small, a 1% move in a stock will result in much more market data being produced than if it's a tick increment that's much larger. There are technologies to handle this, but this is one of the trade-offs that need to be measured and taken into account. There's also different types of investors who have who get different outcomes with different regimes. If the ticket sizes are too small, that's probably good for retail investors with small orders because they can get they can get all of their size done at the best inside possible spread. If you're an institutional investor trying to move large blocks, you may be better off with larger ticks with more size accumulating at those ticks. If tick sizes are too large, it really reduces the opportunities for traders to compete on price. And the flip side of that, and this is sometimes a question of what do high-frequency traders want, what market structure. And I think it's very different depending on trading strategies. But generally speaking, if there are fewer tick increments and less price variation, that favors the very fastest traders who can get to new price levels first because they can get to the front of the line at every price level when there's a change, as opposed to if it's easy to compete on price because there's more increments that you can price at, then speed is less of a benefit. Large tick increments create artificially wide bid-ask spreads that probably cost retail investors. Also an interesting question, and one of the reasons that we talk a lot about holistic market structure review and comprehensive market structure review is it's hard to view these issues in isolation. And a lot of these issues overlap with pricing and with dark trading. In this case, I just wanted to highlight that if tick increments are too large, it tends to drive volumes off of the public markets to various forms of dark pools and internalization. And I've got a chart that represents that a little bit later in the presentation. So how should we measure tick sizes? I think there's a lot of different ways that have been suggested in the academic literature. One way of measuring tick sizes that I wanted to highlight is with a ruler. No, one way that I wanted to measure, highlight is something called spread leeway. And this is a concept that has been mentioned on occasion, generally by exchanges, but it's not something that I've seen a lot of academic interest in. And it's an important measure, from my standpoint, an empirical measure of the appropriateness of a particular tick increment. And so I'll try and avoid long, drawn-out formulas because my math isn't that good, and it's getting late in the day. We just had lunch, but basically, it's the average quoted spread. So if a stock trades with an average quoted spread of, let's say, 3 pennies, and the tick increment is 1 penny, it's the average quoted spread divided by the tick increment. So 3 divided by 1 is 3, and then you subtract 1, so it's 2. So if in the U.S., it's very easy, where just about everything trades with a penny tick increment. To do this calculation. In other markets where there's variable tick increments, or where in going forward with the penny pilot, tick increments may move up on many stocks to 5 pennies. This measure becomes really helpful in understanding the extent to which spreads are constrained by the minimum tick increment. So the question is, we talked about a little bit about tick increments that are too small or tick increments that are too big. The question, how do we optimize this? What spread leeway is just right? And relying on some of the exchange work in this area, Bats at one point in the U.S. suggested that 1 to 9 was an appropriate range. Bats in Europe said 3 to 10. The Deutsche Börse said 5 to 19. There's lots of different opinions on what the right range for spread leeway is. And again, as I mentioned, it's a trade-off. It's a trade-off. The lower the spread leeway is, that means that it is more difficult to compete on price, but it probably means you'll have more size on the inside in that market. For purposes of our internal study, we've conservatively considered 2 to 9 to be the optimal range, and we'll talk about this a little bit. But I do want to just highlight that we've not empirically derived that range, in that it is based on sort of relying on what the exchanges have said in the past and sort of our traders' intuition as well. So there's work to be done in the future by academics and others to help refine these ranges considerably. But from our standpoint, between 2 and 9 gives enough price variability for people to improve price and compete on the basis of price, but not too much or too little. So we did an empirical study of spread leeway methodology, and sort of empirical spread leeway. I want to talk about the methodology a little bit. Basically, as traders, we sort of approach this a little bit differently, and people were debating these issues and talking about the issues. And I asked the very simple question, well, how do things trade today? What do things actually look like? So we did a study of that internally. We looked at all U.S. NMS stocks and ETFs with a share price of greater than $1. So we avoided some of the complexity of the stocks that traded in sub-penny increments below $1. And then we looked at bid-ask spreads and prices, and we sampled them every second from the second half of last year during regular trading hours. Because of some strange behaviors at the open and close, we threw out the first and last 5 minutes of the day. And for simplicity, we just looked at the 8 highest volume exchanges, which accounts for the vast majority of exchange-traded volume, and went ahead and sort of measured spread leeway, measured spreads, measured prices, and made some observations around that. The caveats are this is an internal study. We're pretty confident in the data and the conclusions, but this was not published or peer-reviewed. And so I do suggest that people try this at home and they can do their own studies, and I think there's a lot to be learned here. So going forward, we looked at all of the universe of all the stocks. And what we noticed was that there was a lot of weight to the left side of the distribution, which means the vast majority of stocks trade with very low spread leeways, meaning that most of the time they're constrained by the penny tick increment. There certainly are some stocks that trade with a spread leeway of more than 20 to the right. And in order to make this readable, I combined points 9 through 20, and that's the little bump as you get closer to the right. But generally speaking, there's a lot of weight on the left side of the distribution, which means that overall, tick increments in the U.S. at a penny seem to be too large. I drilled down further within the less than 1 spread leeway range to see, okay, how constrained are these stocks that are less than 1? And you can see that that there are over almost 700 stocks that trade with an average spread leeway of less than 0.2, which means that the average spread throughout the day is less than 1.2 pennies, meaning that they're constrained almost all day long by the penny tick. So we drew some pie charts based on the data that we found. And what it showed is that looking at the whole universe, over half the stocks and the ETFs that we studied tend to trade with a spread leeway of less than 2, and therefore may be a tick increment that's too big based on the empirical way that observation of the way that these trade. It also looks like market quality in these symbols might benefit not by increasing the tick increment, but possibly by reducing the tick increment, consistent with some of the exchange proposals and other proposals that the academic work seems to suggest might be helpful. Another point, because the large cap stocks that trade the most, the highest volume, most liquid large cap stocks tend to be the ones that have the really low spreads, most of the trading goes on there. So when we're talking about a tick size pilot for small cap stocks, that's not where most of the action is. Most of the action is right here in the large cap stocks that are constrained by the penny tick. You can see that, based on this, 88% of the shares traded are in symbols where the tick increment may be too large by this measure. It's worse for large cap stocks, as you would expect. I'm not going to spend a lot of time on this, but 92% of the shares traded in large cap stocks may have tick increments that are too big. And moving forward in mid and small cap stocks, it's more balanced. However, still the stocks that are constrained by that penny tick tend to account for most of the trading, even in the small and mid-cap universes. So Amy already did a good job of describing what the tick size pilot program is, so I'll go real quickly through it. Market caps, it applies to stocks that have market caps of less than 5 billion with a stock price of more than 2 and that trade fewer than 1 million shares a day. Now this is where it gets really fun, is that they then broke out that universe of stocks into 27 different panels based on low, medium, and high ranges for share price, for market cap, and then for trading volume. And within each of those panels, there are now 4 groups that will be measured going forward. A control group where there's been no market structure change, and then 3 other groups with different panels. And I won't go into the details because Amy did a very nice job with that, but basically 3 different experiments that will be run simultaneously against the control group. As it's been mentioned a couple times today, I'm a little concerned that the pilot program itself is very complicated, and that because it's applying to such a small percentage of the shares being traded, we may not get really a valuable experiment out of it, because everyone that trades these stocks will need to weigh how much they want to invest in optimizing their trading performance for the various panels for stocks that in each group, with each rule set, have less than 1% of the total daily volume in the market. So I am a little bit concerned about that, and that's worth observing as we go through the pilot program. So within the pilot securities, this is just a breakdown of the current spread leeway within the pilot program. And you can see that there are still a lot of stocks that currently trade in a range that once we go to nickels, they'll be heavily constrained. And so this is not just about stocks that have 30, 40 cents average spreads. We're talking about many stocks that trade close to a penny or 2 spread wide all day long. So it really could have a significant impact in the way these stocks trade. And then the last slide that I teased a little bit earlier on is sort of the relationship between this spread leeway measure that I'm suggesting and dark trading. And by dark trading, I put it in quotes here because it's not just dark pool trading, but anything that's from the TRF volume, so anything that's not on one of the exchanges. But what you can see is that the stocks that are most constrained by the penny spread tend to trade a lot more off exchange, and the ones that have the most leeway tend to trade much more on exchange. So just indicates that the value of doing a comprehensive, holistic review of the markets to understand the relationships between these different rule sets and the market that we're hoping to create. I think that's it. Oh, I've got to go quickly through my conclusions then. So while I definitely think there's opportunity to improve upon our one-size-fits-all regime for tick increments, we do need to recognize that there are some balancing acts, and different types of market participants get different outcomes from different decisions that are made at this point. I do urge people to think about this metric of spread leeway as a good way to measure the outcomes and the behaviors that we observed during this pilot program. I will point out that today most of the trading is in highly liquid large cap symbols where the tick increment is arguably too big. and the tick size pilot doesn't do anything currently to measure that. The proposed and very complex tick pilot is going to actually move a lot of the smaller cap stocks into that category, being very heavily constrained by the tick increment. And I would urge that a better way to improve market quality might be instead to consider smaller sub-penny ticks for highly liquid large cap stocks. Thank you.
Thank you. And our final speaker is Professor Pete Kyle from the University of Maryland.
Do you need this?
Yeah, I need this. Well, thank you very much. It's really interesting. I'm going to make a generalization here, how the Catholic universities around the United States, and I guess Georgetown is number one, have embraced business education in a way that they didn't embrace it 30, 40 years ago. There are a lot of kind of ethical and policy issues that come up in business, but there are also a lot of research issues. And what I'm going to talk to you about today is not registering my software, but I'm going to talk to you about some research that I have been doing that relates to the conversations that we've been having today in lots of different ways. And in particular, I'm going to talk about a concept that my co-author, Anna Obajayev, and I call market microstructure invariance, and I'm going to talk about how it relates to market liquidity. I wanted to just disclose that I actually work for an asset management company as a director, but I've also worked for the CFTC and the SEC and other agencies over my career, although I'm not working for them right now. So take the proposition transactions costs have fallen, which is kind of what this conference is about. How do you measure that? There are lots of different things that go into measuring transactions cost. You've got market variables, like what's the dollar volume in the market, what's the volatility in the market, and maybe perhaps even some other features, but I'm going to focus on dollar volume and volatility. You have traders who are placing orders. We call them bets, but they're traders who are executing orders in the market, and the size of the order and the speed with which the order is executed might affect the transactions cost. And then you have all kinds of institutional variables that make markets either similar or different depending on what these institutional variables are. You've got technology, which has been changing over time, and it also differs across markets. The bond market is much less technologically sophisticated than the futures markets of the stock market. Competition is different, regulation is different. And one example we've been talking about a lot today is tick size. So the proposition that I would like to make as a scientist studying this is that we need some sort of common denominator that we can apply across markets so we can separate these three different types of features of the market. And so what I'm going to, when you look at these markets, you do see these huge differences. With stocks, you have a relatively small tick size, I'm going to argue, compared to what you see in the futures market. In the corporate bond market, you have a tiny tick size, but you have fragmented markets, a kind of dealer market structure that's quite different. So the institutional differences across these three types of markets are quite profound. So what I want to do today is briefly introduce this concept of market microstructure invariance, and I'm going to do it using a concept that I call L, which stands for liquidity. And I'm going to define L and relate it to things like business time, the size of trades that people make, the transactions cost that they incur, and even you can even relate it to market resiliency and the accuracy with which prices reflect fundamental value. And then I want to apply it to these markets, not only stocks, bonds, and futures, but also to the repo market to develop some insights that will give us a unified view of lots of different markets at the same time. And I'm going to make some specific comments about some specific things that have happened recently, including discussions of tick size, some things that happened during the flash crash, and also what I consider to be a much more significant event than the flash crash, and that's the Société Générale situation with the rogue trades of Jerome Kerviel in 2008. So the idea behind market microstructure invariance is to apply a simple benchmark model to all markets using some variables that would allow you to kind of compare corporate bonds, the futures market for trading stocks, and the equity markets in the U.S., which most people would consider comparing apples to oranges to bananas. But let's find a common yardstick that allows us to treat those all as being comparable so that we can understand how the different institutional arrangements that you have in these three different markets might teach us something about the other markets. So that's the basic idea here. But also, in addition to the policy applications that I just mentioned, You also have the idea that traders can use this perhaps to predict what transactions cost would be in the market. So let me talk about market microstructure and variance. It's the idea that people are placing bets in the market. They go into the market to buy a bunch of stock or sell a bunch of stock. They may shred the order into many different pieces and execute it over time. But we want to measure the kind of the original bet, so aggregate shredded orders up into a big bet that some people would call a meta order. And the concept of market microstructure and variance makes some hypotheses about the size distribution of bets being the same across markets when they're measured in something that we call business time. And business time is the rate at which bets are arriving in the market. You might get 1 bet per day on average. You might get 100. You might get 1,000. You might get 10,000, depending on how active trading is in the market. And the idea of the bets transferring the same risk across markets can be also applied to the idea that the bets have the same transactions costs and that the efficiency or the resilience of the market is the same, but it's the same when measured in some appropriately scaled units of business time, the rate at which the bets are arriving in the market. So here's my proposed measure of liquidity, and it's going to be comparable to Richard Gorelick's measure of tick size in some sense. I think there's a synergy between these two concepts that as a researcher I'm eager to exploit. So what you do is you take the dollar volume in the market and divide that by the returns variance. So for a typical stock, we think that in the bottom of the S&P 500, the dollar volume might be $40 million a day. And that would be in the numerator there. And the returns variance might be 2% per day squared, because 2% is the standard deviation. You take that ratio, and then you take the cube root of it. So the magic here, we think of this as a magic number, but the magic is in the cube root. But notice that both the numerator and the denominator are measured in units of time. So it doesn't matter whether you use daily rates or monthly rates or annual rates. You're going to get the same number regardless of how you measure it. And so what we think is that this number L provides a very simple benchmark that can be used to make comparisons across what seem to be very different markets. The stock market, the futures market, the corporate market for corporate bonds. And so what does L actually mean? Well, if you multiply it by just the right constant, and we think of this constant as being like a physics constant, it'd be like Avogadro's number or Boltzmann's constant in physics. But if you multiply it by just the right constant, then 1 over L measures the average costs, the transactions cost that investors incur in the market when they trade in that market. And it's measured kind of in a fraction of the value traded. Think of it as basis points, multiplied by 10 to the minus 4. What invariance says is that if you want to ask how big the bets are that people place, that is how much they trade, our intuition is that most institutional investors are not really constrained by the amount of capital they have. They're constrained by the liquidity in the market. So if you double liquidity, they'll trade twice as much. And that leads to the proposition that if you scale the bets that people make by the liquidity of the market, you're going to get a distribution that's kind of the same for all markets. Okay, that's proposition number 1 in some sense. How fast do bets arrive in the market? Well, it turns out they arrive in the market at a rate that's proportional to the squared value of L. And the 1/3, 2/3 that shows up in that 1/3 power comes from the fact that it's squared here, but it's not squared on my previous slide, where the size of the bets are proportional to L. So it's a 2-to-1 ratio that has to add up to 1. That's where the 2/3 and the 1/3 come from. Well, what about transactions costs? Well, clearly the transactions costs of executing a gigantic bet are going to be much higher than the transactions cost for executing a small bet. But we think that the dollar transactions cost of executing a bet is going to be the same if you pick a bet in the same percentile for all stocks. So if you pick a 99th percentile big bet in one market and compare it with a 99th percentile big bet in another market, those transactions costs should be the same in dollars. It'll be a smaller bet. And the basis point transactions cost will be smaller. That's why this formula you see is multiplied by 1 over L. So to give you an idea, if you double L, that's doubling the liquidity of the market. What's going to happen is traders are going to place bets that are twice as big, but any bet in a given percentile of the distribution is going to have a transactions cost that's 1/2 as much when measured in basis points, and therefore the same when measured in dollars. So there are different types of transactions cost functions here, but the one that's most important for us to think about is just think about the bid-ask spread cost of executing a bet. It's going to be proportional to 1 over L. So bid-ask spread cost should be proportional to 1 over L, and that's going to take us into a discussion of tick size. Well, what happened during the financial crisis? There's this issue of whether transactions costs have been going up or down. If you look at a picture that finance researchers put together about transactions costs, you'll certainly see that transactions costs rose during the financial crisis and came down afterwards. Well, why did that happen? Well, I think a lot of it happened because L actually fell during the financial crisis. Why did it fall? Well, remember the numerator is dollar volume, and dollar volume dried up, and that'll make it fall. Remember that the denominator is volatility squared, it's variance, and variance exploded. So the denominator went up. So both of those things acting together made liquidity go down. And so a lot of the variation in liquidity is just going to be explained by variation in L. But there may also have been some variation in liquidity that's been explained by things like variation in government policy, tick size reduction in the early 2000s that Ingrid talked about, and other things that have been happening in markets. Well, there's a theorem, mathematical theorem that I'm going to spare you that says that defining L the way it's defined is the only way to define it if you want these invariance principles to hold. So let me skip on to the next slide. So what does this have to say about repo markets? Well, many people think about, in a repo market, you've got a collateralized loan that's essentially got maybe a one-day maturity. So what's the appropriate haircut, or how much of a down, what's the loan-to-value ratio for that loan? Many people think that it should be somehow proportional to the standard deviation of daily returns. But I don't think so. I think that you need to take account of how long it would take you to liquidate the collateral if the collateral defaulted. And some markets are less liquid than others, so it would take you a lot longer to liquidate that collateral. When you do the math, it turns out that the haircut should be proportional to 1 over L, not proportional to the standard deviation. In more liquid markets, you can get away with smaller haircuts precisely because the collateral is very liquid. And indeed, we think that trading in general takes place at a rate proportional to the rate at which bets arrive, which remember is proportional to L squared. So that's my application to repo rates. So what Professor Anno Bjajev and I did in a paper that we're getting peer reviewed right now is we tried to calibrate what L is by looking at a data set of portfolio transitions for stocks. And we calibrated it to what we think of as a typical stock kind of at the bottom of the S&P 500 that has $40 million per day in trading volume and 2% volatility per day. And what we discovered were that the bets themselves, based if you treat a portfolio transition order as a bet, seem to have a log normal distribution, which was kind of interesting. But L turns out to be, depending on the way we run the model, I'm going to call it 50 basis points. It's an approximation. I think one of our models was 45 and another one was a bit less. But for today's discussion, 50 basis points. But 50 basis points is the average cost of executing an institutional order. And because the standard deviation of this distribution of order sizes is so gigantic, many of the bets, half of the volume is kind of the largest 5% of orders. And the market impact costs on those large 5% of orders are really, really large. So most of the transactions cost in the market are going to be large market impact costs associated with the largest bets. The smaller bets, even the medium bets pretty small, they're going to incur a transactions cost maybe only a tenth or less as much, maybe 5 basis points or even 3 basis points, something like 1 penny. On a $30 or $40, $20 to $50 stock. We estimate that there are about 80 bets per day in this typical stock, and we find that the price discovery, 50% of the returns variance comes from less than 1/10 of 1% of the bets. That was kind of our empirical observation about the stock market. Well, let's just take our results for stocks and extrapolate them to the CME futures contract. Well, the volume in the CME futures contract is about 10,000 times higher. We don't really appreciate how much trading volume there is in the CME E-mini contract until you look at the numbers. It's about 10,000 times higher than the trading volume for an individual stock. Volatility is a bit lower because it's the market index, but the result is that L is going to be more than 10 times higher. I'm using an estimate here of 13 or 14, kind of a guesstimated number. I'm suggesting that if L is 50 basis points for a typical stock, it should only be about 3 basis points for S&P futures. 3 basis points in S&P futures is slightly more than 1 tick. So what that means is even pretty big institutional investors can just go in and take out the offer in the S&P E-mini contract and get their order done and incur a transactions cost of 3 or 4 basis points. The bid-ask spread, is about that much. You can extrapolate that a median-sized bet is about 1.5 million, 30 contracts or so, but that business time is operating. I think people think futures markets things are operating fast. Well, We think it's operating about 175 times faster. I think it was 100. It's kind of a vague range, 150 to 200 times faster, a lot faster in the futures market. Let's think about tick size. Well, tick size, it turns out, should be proportional to L. If you look at an $80 stock with a penny tick size and compare it to a 0.25 tick size for the CME E-mini contract priced at 2,000, the percentage is the same. It's about 1.25 basis points. But we think that that's not the right way to think about tick size. The right way to think about tick size is that it should be proportional to L. So when you realize that the CME futures contract has got a liquidity that's maybe 10 or 15 times higher than stocks, the relative tick size or the effective tick size in the CME E-mini contract is 10 or 15 times higher than it would be for that $80 stock. So it's a really big tick size, and that's consistent with the hypothesis that there's a lot of size at the bid and the offer in that market. I'm going to give you another application of this, order execution speed in the flash crash. Now I have another paper with Anno Vijayeva and Yajun Wang that develops the proposition that the way people trade is they trade smoothly, and you see this now. You see order shredding, where people take 1 million shares and shred it into 100-share increments and dribble into the market over some period of time. Well, how fast is appropriate? Well, for a gigantic order in a typical stock, you can look into something like the Incerno data and see that institutional investors buy these stocks over periods of time for like, months. So those would be the largest bets. Well, what does that mean for futures? If you want to do a gigantic bet in the S&P E-mini, you're going to be doing it maybe 150 times faster. So instead of it being months, it's hours. But what happened during the flash crash? Well, during the flash crash, a very large trader came in with a truly gigantic bet, like $4 billion. And instead of executing it over a few hours, they executed it over like 30 minutes or something, much faster than normal. And according to our model, if you kind of deviate from the typical equilibrium strategy that people follow, you create a lot of temporary price pressure that quickly reverses itself. That's exactly what you saw in the flash crash. And also, what you see is that when a very gigantic bet comes in, is executed faster than the normal rate, the price falls immediately, but the bet doesn't get executed until the price is actually recovering. So the theoretical model implies that the selling will take place as the price is rising back up again, not as the price falls. So, I kind of disagree with the remarks earlier about the flash crash and the CME's role in it. I think that this large bet that hit the CME in the flash crash actually caused the flash crash. Of course, it didn't cause the stock market systems to malfunction. They were programmed to malfunction, and the stock market would be much better off if it would introduce the stop logic functionality that the CME has had for quite a while. Let's look at the liquidation of Jerome Corviel's trades. Remember, a rogue trader was discovered in January 2008 to have accumulated a 50 billion euro position, far bigger than the flash crash bet. And they tried to quietly liquidate it over 3 days. Of course, there's no way to liquidate 50 billion euro stock trade over 3 days. If you had applied the L formula and extrapolated a linear price impact model to it, you would have predicted that this would have reduced stock market prices in Europe by 10%. Well, that's almost exactly what happened. Recall there was an emergency meeting of the Fed. Interest rates were cut by 75 basis points. People knew that this was going to be a big thing, and indeed it was. Now let's extrapolate the other way, corporate bonds. So typical corporate bond only trades a few times a year. There are thousands and thousands of these bonds, but typical one maybe has a volume that's 1/10,000th the volume of a typical stock. And it's got less volatility too. So L is really, really smaller by a factor we think of about 25. So that implies the cost of an institutional bet would be 1,250 basis points, meaning that they're going to be very, very, very unusual for an institution to want to take that kind of transactions cost hit. But the bid-ask spread for a small trade would be about 100 basis points. So we think that if you look at the trace data, you see trades occurring plus or minus 300 basis points or three percentage points from the prices of the bonds. I think if you had a more reasonable market microstructure that allowed order handling facilities that were reasonable, you would, instead of seeing the 300 basis point transactions costs, you would see maybe something like 100 basis points. But that would be quite good for small investors who feel like they might be getting ripped off in the corporate bond market, and you can indeed look at the trace data and see that they do seem to be being ripped off. Now, the market there is going to be operating at a much slower speed, maybe 600 times slower. So you're only seeing a few bets per year. If you want to sell corporate bonds, you're not going to be able to sell them very fast. You're going to have to sell them really, really slowly, shop them around, take a while to liquidate your position. So illiquid fixed income securities don't have a lot of instantaneous liquidity. Dealer markets. If you have a dealer market like the bond market, dealers probably hold inventories proportionally to the speed with which the market works. So my conclusion is using this measure L might give you a common denominator for comparing markets to different markets over time. I mean, the same market over time and also different markets at the same time. In particular, we've had a lot of discussion today about tick size, and I think tick size should be proportional to L. So I'm thinking I'm going to get a student to work on Richard's idea and see if L explains your measure of how close you are to the minimum tick size as a multiple of the average bid-ask spread.
Thank you. And I'm sorry that we're out of time for this session, but we have another exciting session coming up. Somebody's holding up a sign which says "Move Q&A," move to Q&A. Oh, I thought I had to cut. I thought I had to finish now.
5 minutes. I couldn't.
Oh, okay. Oh, good. I'm glad we have time for 5 minutes of Q&A over there.
Peter, this is a very interesting measure. I wonder, this measure seems to combination of the traditional liquidity measure and the WIX, the risk measure. We're sure there are going to be a lot of liquidity measure. Can you suggest any criterion how we can adjust? This is a new measure. What is a comparative advantage of this one? What additional information it brings to us compared to the traditional liquidity measure? Thank you.
Okay, so I think that if you look at a traditional liquidity measure, including my own liquidity measure in my 1985 paper, you essentially need a different liquidity measure for every stock. And the empirical problem of estimating liquidity measures is one of taking a stock and then trying to discover its liquidity measure by an empirical investigation that maybe regresses some measure of transactions costs on a bunch of different variables. Maybe it could be regressing something as simple as regressing bid-ask spreads on a bunch of different variables. And what we think is that the advantage of this liquidity measure is that you can use the same actual number for all stocks. And you really don't have to do a regression with it that estimates coefficients. You just have to estimate a constant term. It'll be the same constant term for all stocks. And that will provide you with a benchmark. It won't measure liquidity perfectly because liquidity will also be a function of perhaps some other things, including all kinds of regulatory conditions and tick size and technology used for trading and things like that. But it would, we think, give you a perspective for then measuring how those things actually affect trading costs. But I look forward to a future in which we run a horse race between various liquidity measures to see how this one stacks up. I don't think it's going to explain everything, but I think it'll turn out to be a good benchmark because it applies so generally. These other ones, like there's a measure by Amihud, for example, that's similar to my 85 paper. The time units in it are kind of funny. And the way his measure is going to scale is going to be a little bit different from the way our measurement scales. Another advantage of our measure is that it has implications for how big the bets are and all kinds of implications for other things. Like, for example, liquidation of repo collateral, like I talked about. These other measures would have the same implications theoretically, but those implications would be, I think, kind of ridiculous in their empirical realism if you extrapolate it by a factor of 10,000. Here, when we extrapolate by a factor of 10,000, we get numbers that you can disagree with, but they're at least reasonable.
Right? So going to your liquidity measure, it's still a stock level measure, right? So somehow similar to Amihud, so I think about the volume. You may still have the volume issue, right, at the stock level. That's one thing. And the other one, do you see a way to aggregate and get a pervasive liquidity measure?
Aggregate and get
an aggregated measure to use in, for instance, pricing exercises?
I don't see an aggregate measure. And I do think it's similar to Amihud's measure in the sense that it's got a, I don't want to, a lot of people in the audience don't know what Amihud's measure is, but it basically doesn't have a 2/3 or 1/3 power in it. It's something that just has maybe standard deviation of returns. And the way I think of Amihud's measure, it assumes that the big boys trade in the big markets and the little boys trade in the little markets. And one of these days there'll be a lot of girls trading in markets, but they're not as many as there are boys. so that if the market gets 10 times bigger in terms of volume, everybody's just trading 10 times more, but it's the same number of participants. That's the story that goes along with the Amihud measure. I don't think that's the right story. I think this will kind of stack up quite well against his measure.
So I'd like to give a round of applause to our panelists here.